Good day, and thank you for joining us today as we reflect on what I can't believe is already the end of the first quarter of 2024. My name is Mpho Mtsi, and I'm joined today by the Old Mutual Investment Group Chief Investment Officer, Siboniso Nxumalo. So diving straight in and looking at global markets, Siboniso. Coming into this year, we were expecting interest rates to start falling, and we haven't seen that happening. It doesn't look like it's happening anytime soon. I mean, we've had Jerome Powell telling us that the Fed isn't ready to start cutting interest rates. On our side, Lesetja Kganyago and team are saying they're considering shifting the inflation target, so that would again delay the interest rate cuts. So what is the impact of all this on our investment strategies?
In Q4 2023 and in Q1, we started seeing the market anticipating that there would be rate cuts. And how did the market react to that? We started seeing really strong global markets and global returns. In Q1 2024, we saw the US in dollar terms returning around 8%. So we saw a strong rally from global markets, especially driven by the US and US tech sector. All of that was the market anticipating that, hey, there would be rate cuts in the year and then pricing it in. How do they price it in? You raise asset prices. And now with the market, if we look at the recent data points are saying, hey, inflation is sticky. Inflation is staying high. Inflation is not going away. Oil prices are going up. And so therefore, with that happening, we're starting to see the market become a little bit more cautious because they're saying, hey, perhaps we're not going to get those rate cuts. If we don't get those rate cuts, profits are going to stay under pressure. And the thesis that we've been investing in, that rates, yes, have peaked, but they're going to stay higher for longer. And eventually that bears out in pressure on economies, in pressure on profitability, pressure on consumers. And that's then not good for asset markets, which means we believe that asset markets should actually be lower or prospectively will generate lower returns. And so this delay of rate cuts actually comes into our investment thesis.
Mm-hmm. Now, looking also at commodity prices. So some of them are starting to tick a little bit higher than the downward trend that we saw last year. What is our view on this sector globally, and what can we expect for the rest of the year there?
The story of this quarter was gold. Gold completely outshone everything else, so I suppose literally and figuratively in the markets. We saw a company like Harmony Gold return over 60% in the quarter. We saw the other gold companies return over 40% in the sector. So very strong performance from gold. We saw some of the platinum companies, after a very tough start to the year, they also started coming back and recovering quite materially. But actually, the rest of the commodity spectrum was neither here nor there in the quarter. Yes, we saw recovery near the end of the quarter, but actually, given what had happened in the beginning of the quarter, they kind of struggled. Our view on the commodity sector is that actually we are underweight commodities. Why are we underweight commodities? Well, what's been driving commodities probably over the last 2 decades has been China. China has been an extraordinary economic miracle. And China is the biggest consumer of commodities globally and has been so for the last 2 decades. Now, China has got a challenge. Its challenge is its property sector. So they've overbuilt, and if you looked at their fixed investment relative to GDP, they are at double what the normal average is. And so China's population has also peaked. So do you need that amount of infrastructure? And we're seeing Chinese property companies coming under immense pressure. Chinese governments, also state governments, coming under immense pressure, and so therefore they've got too much debt. The population is starting to decline, has peaked, and they've got too much property. And so you've got all these ghost towns that people talk about. And so therefore, we're looking at this and saying, actually, in future, we are doubting that there'll be a stronger demand for commodities as has been historically. Also, we're seeing the Chinese market, which has been really struggling. It's showing good value, but it has been struggling. But the Chinese government is reluctant to stimulate in the old way, using infrastructure to stimulate the economy to further growth. And so therefore, we are nervous about the commodities sector. And so we are underweight in our funds. But also it aligns, again, with our themes and saying that we're seeing a world that's going to be under pressure, that's going to slow down. A world that slows down is never good for commodities demand. And so therefore, again, our view on commodities is be cautious. We obviously own some commodity companies, but we own them selectively. Like we will own the oil company Sasol because nobody has invested in the oil sector. And so therefore, the laws of demand and supply is that, well, we still need oil. We still drive cars. They might be EVs, but even those are declining in sales. And so therefore, we are selective where we are finding value in the commodity sector, but we are avoiding generally the ones that are linked to Chinese property.
Okay, and I like that you mentioned Sasol, you mentioned Harmony Gold. So looking at all the South African companies now, there seems to be some value that's coming out of SA Inc. But which stocks or sectors are delivering returns, and where do you see potential specifically in the local market?
Yeah. South African market is actually looking really attractive. So if you look at it just on the law of averages or the PEs, what you're paying for South African companies, actually it is looking really, really attractive. The trick, though, is that there are risks to it. So we're seeing great prospective returns in South Africa, but we've obviously are building portfolios for clients over the long term, and we've got to then balance that with the risks that we see. So in South Africa, in May, there's going to be an important election. That particular election, in theory, should transition the country from being ruled by one party to some form of coalition government. Now, that doesn't necessarily frighten us because most countries in the world are actually led by some version of a coalition, except they've had experience doing this. And in South Africa, we're about to learn how coalition governance works. And so for us, then we look at South Africa and we say, well, depending on which parties come together to form the government, that is a risk. Because when we look at the manifestos and the economic policies that are being proposed by the various players, some of them are completely divergent and not necessarily market supportive. So what have we done then in the portfolio? What we've done in the portfolio, again, aligned to our themes of saying, hey, we're seeing more risk in a world that should slow. So we want companies that can grow earnings through those cycles. So if we look at our companies, again, we are buyers of British American Tobacco because irrespective, it's a globally diversified company. It earns earnings from all over the world. And so for us, and also we're buying it at a very low multiple with a very high dividend yield. And so that is attractive. Anheuser-Busch, the biggest beer company in the world, again, that is a company very diverse, amazing logistic, great business, and again, attractive valuation. And as soft commodity prices, which had put pressure on it since the Russia-Ukraine war, those start waning, we're starting to see that company recover. And so again, that's a company that's got earnings that can grow, and it's not necessarily, it's listed in South Africa, but actually some of its operations are only in South Africa. Then we've also been buyers of a company like Aspen, the pharmaceutical company, which again, yes, is a South African company, but actually it earns earnings outside of South Africa. Now, in South Africa, one of the things our analyst team has been looking at is to try and understand which companies are going to be the winners and which ones are going to be the losers per sector. And so what we call quality, we've been paying a lot more attention on the quality, because it's not just the valuation, but you've got to pay attention to the fact that actually, are you going to find a winner? So we own, in terms of the retail space in South Africa, Pick n Pay, a company we don't own, is really, really struggling. It's got lots of debt and actually needs some form of restructure. But on the other side of that, we own Shoprite. We've owned Shoprite for quite a long time, and our clients have benefited from that. Shoprite is really strong. They're investing. In fact, Shoprite's capital expenditure is almost equal to Pick n Pay's entire market capital. So we think Shoprite's got a really strong competitive advantage that is growing. And so for us, we're paying attention to companies like that are resilient, that can grow earnings, and hopefully they've got a diversified, globally diversified income stream.
And I'm keeping with equities before we close off our market views, but what is your overall outlook for equities globally? And given this continuing debate and activity around inflation and the interest rates?
Yeah. So when we look at equities, when we look at, we compile this chart that's in terms of looking at long-term returns and long-term prospective returns. We see the best returns in South African equities, in South African government bonds, and in South African property. Because the valuations there are attractive. But obviously, like I said, you've got to balance it with the risk that I've just spoken about. We are seeing the smallest opportunity in terms of the lowest returns in global equities. Why? Because global equities in the US, they keep their global equities, the US equities, again, their price is rather high in a market that's very concentrated on amongst very few players. And also we're finding that there are margins. So not only are you paying a very high price for the assets, but you're paying it on very high profitability. And for us, we think that those expectations are really, really high and are somewhat going to be difficult to maintain in a world where inflation seems to be a lot stickier and interest rates aren't going to be there to support the market at the speed that the world is expecting. And so for us, we're not finding great opportunities offshore. We're finding great opportunities actually elsewhere. If I mind one more thing, the second largest market in the world is the Chinese market. So the Chinese market is trading on multiples that are actually some of the lowest they've seen in the last 2-3 decades. So again, there must be opportunity in Asia. So we've taken even our global equity exposure, rather than putting it in the US where we are concerned, actually some of it is in Asia, because we think, yes, we might not like the commodities with China, but actually China has also got other assets that are interesting, that are trading at attractive valuations.
Thanks for rounding up those market views for us, Sibu. Now, specifically looking at our performance, our funds have continued to experience quite a bit of pressure from various market challenges. What can you tell us about the Q1 performance?
Yeah. So for us, when we sum up our performance, when I started off by saying the US was strong, that global markets were strong, that should already tell us, because again, our positioning is cautious. It's away from the US. And so therefore, strong markets aren't going to favor, I suppose, our investment products. And so therefore, we struggled in the month in terms of our main multi-asset funds, stable growth fund, balanced fund, and our main equity funds, which is the investors fund. Now, the interesting part of that is that there's a fund, or the Old Mutual Equity Fund, which 60% of it, 60-70% of it is a domestic equity, but the other bit is just over 33% is global equity. That fund was top quartile in the quarter. So the domestic equity fund, investors fund, was fourth quartile. The one with the global equity, with the same stocks, exactly the same stocks, that one was first quartile. Why? Because the offshore growth. So the offshore part shows how that actually was able to overwhelm the South African returns. And so for us, in terms of our returns, that actually kind of explains offshore was really strong. We aren't positioned to benefit from a strong US. In fact, we are positioned to perform from a weaker US. Now, when we then go further on and look at our other strategies, the ones that actually also did well, continuing, like I've said, with the Old Mutual Equity Fund, we've now got a feeder fund for the Global Managed Alpha Fund, which I've spoken about before. And this strategy has been around for 7 years. It's a systematically based investment strategy. It has generated alpha for 7 years. It's a 4-star, 5-star rated, Morningstar rated fund. And for us, this particular strategy has outperformed some really, really great strategies. And so for us, it's a strategy we're proud of, and actually domestic investors can now access it much easier. And it continued its strong performance. And also we can see the same in our global capabilities in the Sharia global equity fund, and so Islamic equity fund. And so again, that was strong. And so that's where we've got pockets where we're strong, which great performance, which is the offshore. And in the domestic equity and multi-asset funds, those tended to struggle given the strong global markets.
Thanks, Sibu, and thanks actually for highlighting especially the global performance. I know increasingly investors are taking their money offshore, seeking those diversified returns. So it's great to hear that our global portfolios are continuing to really generate incredible returns against global peers. So now we're firmly into the second quarter of 2024. Can you share where you and the team are seeing potential pockets? I mean, you've already shared a little bit already, but potential pockets of growth across different asset classes and sectors.
So our views, I haven't changed. Investment views, we take long-term. We produce a document annually called Long-Term Perspectives because we study data from the 1800s all the way to now, and we look at market cycles, and then we say, okay, fine, where should returns be? And so, like I said, we're finding South Africa has got great value, but the problem in South Africa is you've got to choose your assets. And we think we want to preferring to choose more quality assets than non-quality assets, and assets also that have got diversified income streams. So we're finding that. Like I said, I think I've mentioned China too, that China is looking particularly attractive. And again, there's government bonds in South Africa, which closed the quarter yielding over 12%. Now, considering where inflation is, actually we are very largely overweight government bonds, because on a risk-adjusted basis, we find that to be an extremely attractive return that you can get considering the risk that you are taking. So we find government bonds quite attractive. And again, like I've said, I think the US is not an area that we are finding great value in. It's running, it's got momentum, and it looks very nice. But I think the fact that the interest rates and the data that is coming out is suggesting that, hey, rates must stay higher for longer. We're worried about that. And when that obviously comes off, that could prove rather painful. So we'd rather spare clients that pain.
And perhaps just before we close off, you could share a little bit, especially on emerging markets, for instance, where, I mean, we've spoken already about China, we've spoken about ourselves, but, you know, they're offering a really compelling opportunities in this global uncertainty. Yeah. Is there a little bit more you could share on that?
Yes. So emerging markets, basically, the biggest ones is China, Taiwan, India, and then you've got Brazil, and etc. And what is interesting about emerging markets is that emerging markets have got young populations. So if you look at India, India's got some of the youngest population that are getting educated, and also they've got the fastest growth in the world. And generally, emerging markets used to be the basket case of the world in the sense that they had poor balance sheets. But post-COVID, actually generally, even the developed world has got some really challenging balance sheet dynamics. And so that no longer worries us in terms of emerging markets. Now, the emerging markets, when we look at valuations for emerging markets relative to developed markets, given the strength of the US, emerging markets really, really look compelling at this present moment. And also they've got interesting expertise. So if you look at, say, a country like Taiwan, now we keep hearing this noise about China and Taiwan. Taiwan has got one of the most important companies in the world, a company called Taiwan Semiconductor Manufacturing. And it is producing chips, obviously, which we use in our phones and every digital thing. And obviously, the demand for chips is growing quite exponentially. And if you look at a company like that, it sits in an emerging market, and it is materially important to the world. And hence you're getting these little factions between the US and China and Taiwan. Why? Because it's important to try and protect a company like that. But you access that in an emerging market. And so for us, emerging markets, the value looks fantastic. The population dynamics look very good, again, young, growing populations. And I think also, given then if the US does come off, generally how those cycles work is that then emerging markets tend to show strong performance. So we like emerging markets.
So thank you very much for a valuable catch-up, Sibo. We look forward to the next one at the end of the next quarter. And it's really exciting as well, to hear of the strong performance of the global funds and that launch of the feeder fund for Global Managed Alpha. So for more guidance on your investment portfolios, we really encourage you to reach out to your client director or financial planner, and we will gladly assist. Thank you very much for giving us your time.